Are high yield bonds good for you? This is a question that was asked to me way back in 1996 when I was taking up an interview with BNP Paribas, my first employer after my MBA. And I actually answered, depends. The interview panel was irritated because I said, depends. So they curiously probed further and they asked me, depends on what? And this was my story. I'll tell it to you right away. High yield bond. Okay, so let's understand what is high yield. Yield is the return that an investor gets on an investment. Okay, we have always learned that high yield is profitable, gives you greater return. But anything that gives you greater return comes with a greater risk attached to it. What is the risk? Okay, the risk is of not receiving not just the interest on the bonds but also the principal back. All right, so this is a very curious case of when high yield looks very attractive to you, it sounds nice to your ears, and obviously, like many SMSs that are coming nowadays, you want to grab the opportunity and instead you're losing not just the investment money but perhaps your entire net worth in this. A high yield is something that the investor gets. Okay, yield is a function of two uh, attributes. The first one is the coupon that you get on the bond, which is the cost to the company. The second is the price at which you've purchased the asset. So you've purchased the asset at X dollars, you're going to get a return on that X dollars. If the price increases, the return in percentage term decreases because it remains fixed. Okay, so as bond prices increase, the coupons paid by the company remain the same in dollar terms, but the return on that therefore decreases because yield is nothing but a function of coupon divided by your price at which you have invested. Okay, so this is a good thing. If bond prices increase, investors are bullish on the bonds, right? That means they are expecting the company to do well financially because a bond investor is only concerned about returns, right? In terms of coupon payment and in terms of getting the maturity amount back. The bond trader is also worried about the influence of external macroeconomic factors on the price of the bond. So, if bond prices increase, that means the investors are bullish on the bonds, the yields will decrease, right? So that doesn't make it that makes it a low yield bond. So a low yield instrument is good for the investor who seeks safety, who does not seek risk and has absolutely zero appetite for risk taking. A high, on the other hand, bond prices are crashing. Why do bond prices fall? Bond prices could fall because of a combination of macroeconomic factors and microeconomic factors. Macroeconomic factors include interest rates, they include what is the RBI or the Federal Reserve action in the money markets, etc. So, if they're expecting that the interest rates will increase, then the current bond prices will obviously decrease because the coupon paid by them is not enough to beat the inflation. The microeconomic factors is the credit ratings of the bond issuer itself. If the bond issuer's credit rating was double A at the time of issuance of the bond and therefore it pays a coupon of, let's say, 8% at that time for a 10-year bond, now the financial strength of the company is not very good. In fact, it's collapsing. It might be facing bankruptcy very soon as it faces huge cash flow problems. What will happen to the credit ratings? Naturally, it cannot stand at double A. It will collapse to double B. The issuer will find it difficult to make coupon payments. That means it's in default of coupon payments. And when it fails to make the coupon payments, we understand that the rating gets downgraded even further. And as the ratings get downgraded, the price of the bond collapses, right? Nobody has any interest in that bond. The investors have turned bearish on the bonds. When investors turn bearish on bonds, they start dumping the bonds in the markets. There's a deluge of those bonds across different maturities. There's an oversupply of bonds, and therefore the price of the bonds also collapse. But the company is supposed to pay you coupon at a particular rate. In this case, it was 8%. If and whenever you get that, you've got a very high yield instrument with you. So many of us chase yields, okay? And chasing yields is not a bad thing, right? Chasing yields is an okay, it's good, but we have to have the stomach for it. We have to have the guts of steel for chasing a high yield instrument, because it's entirely possible that the instrument does not pay you back anything in return. High yield is good for the speculative investor, for the investor who's looking to make quick money and has the guts and has an iron will to take on losses on a bond portfolio. It is not meant for people who are putting in their life savings into an investment, because it assumes that there is a lot of risk in high yield. So, high yield is definitely high risk and perhaps high return, whereas a low yield bond is definitely low risk and definitely a low return, something like your treasuries or your GSECs that would give you. So, high yield, do not jump for high yield. Many investors have made this mistake in the last few years, especially because interest rates in India have been so range bound. They have chosen to put money into unscrupulous financial institutions. They have chosen to put money into Chinese lending apps. They have chosen to put money into bonds of companies that have been severely downgraded. Do not chase high yield if you do not have the wherewithal to take on those returns, because in the yield spectrum, in the rating spectrum, the top end is the AAA bonds and the lowest is D bonds, because you don't go below D because it's already been downgraded to D. So don't fall for those traps which promise you high yield, high returns. Okay, many advertisements come out in the papers talking about high yield, agri farms, agri plots being sold in and around particular locations. How do you know? Okay, at least in bonds we have mathematical formulas, we have Excel, we have scientific calculators, we have financial calculators now to help us out calculate the yield. But in the case of an agri farm somewhere lying in a plot, there are even more uh, uncertainties to that, for which for which an Excel sheet will not give the answer, for which there will be no answer for the returns that will be given. So high yield does not mean high return. High yield means high risk, but probably some return. We don't know whether the return is going to come or not. So high yield bonds are meant for hedge funds that have the guts to take on large portfolio investments in turnaround companies. Perhaps it's a turnaround stock. The hedge fund has more information to that. The retail investor perhaps has got no information and no idea about that. So it's very important to remember that high yield does not translate into high returns. Stay safe, because it's your hard work that is giving your income, which will help you build your wealth. So if you're going recklessly searching for quick short-term gains, high yield instruments, please define your risk parameters, because it's your risk and your return. Unlike a hedge fund which has information access literally 10 times more than what we retail investors have. They have analysts who are sitting at their desks 18 hours a day, putting in data into those Excel sheets and building scenarios, and they have very fine high-end economic data, statistical data for which they have paid for, right? We might not have that. We do not necessarily have that. So it's best not to invest on the basis of rumors, tips, and high yields, because it's our earnings, our income, our retirement wealth that we will be putting into this.